Well, it's Tuesday and it's time to check in on the bond markets now. We've had that space benefiting in the past week from the bullish global risk appetite and positive local data releases as well. But traders saying we should start to see focus shift to political developments post this week's municipal elections in South Africa. That with, as Futuregrowth highlights in its weekly report, the jury's still out on promises of more fundamental reforms ahead of the December credit ratings review. So certainly a lack of progress on that front will put the bull rally at risk, especially considering the very large foreign holding. One of the most important developments today, though, is the continuation of the JGB sell-off. The yield was near minus 30 basis points last Wednesday. Today, it traded at minus 1 basis point. The yield rose 6 basis points today, with that poor reception to today's 10-year auction doing no favors. The failure of the BOJ to either manage expectations better or announce more bond purchases has unleashed dramatic volatility in the bond market, and the sell-off here appears to be having quite a knock-on effect in Europe and on US Treasuries, where bond markets are also under pressure. So that a broad look at what's playing out in the fixed income space. Let's get into some of the detail now, and joining us on the line, Wikus Furstenberg from Futuregrowth. Wikus, thanks so much for your time today. So despite a cabinet meeting to discuss the fiscal stimulus plans over in Japan, the market seems to be spooked by the prospect of the BOJ's review of monetary policy that's due to be released next month. What are you making of the moves we're seeing on the back of that? Is it all warranted?
Hi, Alyssa. Most certainly. I think we need to get back to basics here. It's almost like being addicted to something. I mean, markets are being sort of spoiled by quantitative easing, low yields, even negative rates for a while. Now, they keep looking for more. And as soon as there is some sort of disappointment in terms of the size of those announcements, you see some pullback in yield. And I think the bottom line here is that you've got to be, as an investor, you've got to be really, really careful in this environment, especially if you sort of have to invest or are forced to invest in markets where we have negative yields. I mean, clearly low yields mean bonds are especially vulnerable because a small increase in that yield can bring about a large decline in price. And I think to some extent you see some disappointment and you will see a pullback. So, personally, I'd be very, very careful to invest in any of those so-called safe assets at this point.
But let's shift the focus to South African bonds and the kind of allure they boast in this kind of environment, Wikus.
Yeah, for sure. I mean, it's the fact that we have these policies globally. I mean, negative interest rate policies in far developed markets. I mean, it causes sort of like capital to sort of look for yield elsewhere. I mean, it's not just emerging market debt; it's also corporate debt globally that investors are sort of looking to sort of put their money to work. And I think, in a way, you've got to be really careful to sort of use the same brush. But in the case of South Africa, in a way, I would think that this easy policy is basically whitewashing the sins of emerging markets and some of the issues you mentioned for South Africa in particular. So you've got to be really careful how you deal with this. Having
said that, we did see South African bonds trade softer today, of course, taking their cue from that slightly weaker rand that has surfaced. Having said that, is that very much an expected pullback given the kind of performance we've seen over the recent past?
Oh, for sure. I mean, the market has done well. You mentioned foreign buying. I think if we can believe the numbers for year to date, we're sitting at something over 50 billion. Which, reminds me of, 2012, when foreign investors were very keen to buy South African local currency debt. So the pullback, I guess, it should be expected. And as you mentioned, I mean, we have the municipal elections tomorrow, and it's not just about that. It's also about how policy or government would respond to the outcome of these or the election, in coming weeks. And that we will only know in a few weeks' time. We won't know that by Thursday, the potential changes to government policy. And looking for those things that we desperately need to avoid a downgrade.
With that, Wikus, do you see over the short term focus shifting back to local dynamics at play?
I would think so. I would certainly think so. I mean, it's hard to forecast, this global reach for yields and the way it's like a stampede into emerging markets. You've got to be really careful to ignore that train. But, we had good data releases the last week or so, and I think looking forward, I think focus should return to those things that was more of a concern earlier this year.
Before we get to that point, though, come Thursday, focus is on the BOE. What are your expectations there? Are you pretty much in line with consensus, expecting a rate cut to emerge on that end?
I would not be surprised if the Bank of England decides to not do anything on Thursday. I think the market is at risk for a disappointment. I mean, it's barely just more than a month ago that Brexit happened. So you've got to give the central bank some time to, look at data. And a 1 month's data post this event certainly is not enough to make a call like this. So I would not be surprised if the Bank of England decides on Thursday not to cut rates as generally expected by the market.
Well, we wait and see. Wikus, thanks so much for having joined us on the line this evening. Wikus Furstenberg is with Futuregrowth.